Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and this is Mike on Money. Thanks for joining us after our 1 month hiatus over the summer. We're back. We're going to be doing these on a regular basis again, as well as the podcasts and our weekly deep dive videos. Also rolling out some new content this summer where we're going to do some one-on-one interviews with CEOs of some of the companies inside our portfolios, especially the more interesting names in the smaller cap arena, the more niche names that we look at in the portfolios. So look for those as we wrap that up as we get into the fall session here. So thank you for joining us. As always, keep in mind, everything that we talk about here is for information purposes only. Always talk to a professional or do your own due diligence before applying any strategies or recommendations to your own portfolio, because everyone's unique and you want to make sure it is appropriate for your situation, especially on the risk front. And as always, if you're watching us here live today, you can interact with us, ask a question, happy to answer those. Probably going to be a bit longer session today, so we will follow up with any questions that you might send in if I don't get to them on the live session. If you're watching it recorded, as many of you do, by all means, just go to mikeonmoney.com. You can send us any questions there, give us a call, or even set up meetings with us to discuss your individual situation or talk about any questions you might have. So before we dive into our COVID update, of course, it's been just over a month since we've talked, and luckily nothing happened over the summer that we have to catch up on. Obviously, that's not true. We've got an election coming up. We have the whole Afghan situation, inflation, continued volatility or growth. Volatility can mean growth, and we've certainly seen some volatility and growth in the markets. And of course, we still have COVID-19. It has not gone anywhere. But on the good front, I do think there's a lot of good news around that, despite what's going on. I'm back in the office. You can't tell I still have the background because of course, through the pandemic, you know, the office managers decided to start some renovations, and of course they're not done before we're back in the office. So until we get the renos done, I'll have the fake background, but it's hopefully as soon as we're settled in the new offices with our team all in their permanent places, we'll be able to kind of show you the offices a little bit. But with that, let's talk a little bit about COVID-19. So obviously the pandemic continues. We're in what they're calling the fourth wave. Really driven by this Delta variant. However, when it comes to the investment side, obviously on the personal fronts, we return to here in BC and many of the provinces in Canada return to indoor mask wearing. Still the drive for the vaccination numbers, and even we're seeing now in the U.S. Looking at approving the Pfizer vaccine anyway for age 5 and up. So, younger people moving towards vaccines, and also those who are immunocompromised. BC has, and many of the provinces have already approved or are putting into place the booster shot. And we'll probably see that coming for everyone down the road. That's not a surprise, though. If you flash back, which seems like 10 years ago, at the beginning of the talks of a vaccine, it was pretty clear that they knew that the protection would be for a limited amount of time. Right? They knew that when we put in the vaccination, it wasn't because of the nature of the COVID virus. Much like the flu, you don't get just one shot and done. It is something we'll probably look at boosters on an annual basis, maybe not always on an annual basis, depending on how much we get it under control. and also how much we see the variants continue to pop up, because that's the real challenge. And if you flash back to the previous 3-4 months, I've talked about that a few times, whereas the variants that we have to be cautious about, because the more and more the variants develop, eventually the variant can be immune to the vaccine. And that's what we don't want to happen. And that's why global vaccination, not just local vaccination, is really important. And we are seeing that step up. And that's the good news. We are seeing the numbers increasing globally. There's some countries that are behind, and they're working to catch up. And we're seeing that. We're even seeing pockets in the US that are behind, and things starting to catch up. And there are pressures in places. Obviously, a lot of companies now, even governments, US government, mandating you have to be vaccinated to come back to work. The airlines, healthcare workers, all have to be vaccinated, or they're going to be put on leave, unpaid leave. And we're seeing that even in the universities. We're seeing that now with the vaccine passports. If you want to go to a restaurant, if you want to go out to the theater, if you want to go to a movie, more and more people are being encouraged to go get the vaccine, or if they want to return to normal, to go get the vaccine. So when we look at those numbers, it's only going to increase from there. I've seen this firsthand with part of my end of August was spent in Montreal, moving my 2 children into their universities, one going into 3rd year, one going into 1st year. So we went and got them set up. And of course, the universities, you can't go anywhere without a vaccine passport, especially in Quebec. They were one of the first provinces to bring the vaccine into play, or the vaccine passport into play. And they were really accommodating as far as I was able to get the Quebec vaccine passport showing proof of my BC vaccinations. And they had ease for international students to go show their proofs. But they even had on-site vaccination tents right on the campuses, basically allowing anyone. They didn't even have to have insurance, or they didn't have to be part of the Quebec healthcare program. All they had to show was their student ID, and they were able to get the vaccine. So more and more people, we're seeing definitely a spike of people going out and getting the vaccinations. So as we move through that, and we are seeing that globally, while Delta is a concern, it is slowing things down a little bit. It's not, when we're looking long term, we're still looking at an actual reopening, an actual economic reopening recovery phase. So that's what we're seeing in the COVID. Obviously, there's a lot of protesting around the vaccination passports. But at the end of the day, I mean, everyone's going to have their own opinion on this. But at the end of the day, this is the only way we're going to be able to move forward without more variants coming to fruition. And as I mentioned, it's just a matter of time before a variant renders the vaccinations useless or ineffective, I should say. And then we're kind of back to square one with coming out with another vaccine for the new variant. So that's where we're at with the pandemic update. Not all bad news. I actually am very optimistic at the global numbers, that the rate that the global numbers are increasing. And again, if you flash back to Canada, January 2021, everyone thought Canada was way behind on the vaccination rollout kind of efforts and the numbers, and we caught up really, really quickly and turned that around to be one of the leaders in the world. And I think that's what we're going to see more and more globally, is some of the areas that are behind really start to ramp up efforts and move up those ranks. So we'll look forward to seeing those numbers as things move along. Oops, wrong way. Okay, so let's take a look at the global markets for August. What we're looking at, well, no big surprise. CPI, Consumer Price Index. This has been the theme for 2021. Talking about inflation, it's not going away. It's still going to be the topic that we're going to be driving as far as the markets or investments go. So we're waiting for the U.S. August numbers. I'll touch base here in a minute on kind of our expectations, but really I don't expect any big surprises there. we are in, and I have to use this phrase for someone on my team, peak transitory inflation. I'll explain what I mean by that, but it's really important to kind of understand what's going on with inflation and what our expectations are, because that's really what's going to drive kind of where the growth and where the opportunities in the market's going to be. The futures, the stock market continue to show some higher levels. We're seeing, part of the indexes out there, still showing kind of record growth or record high numbers. There is some lagging. There's still some opportunities around, especially on the value side, which are posting some great numbers, but still not getting all the attention maybe from investors that they should. And we'll talk a bit about that here in the second half of the presentation. Fed officials have recently, in public interviews and statements, talked about that they're going to be reducing or beginning tapering of the bond purchases by year end, certainly into early 2022. And that's, a lot of talk about this inflationary pressure coming in 2022. Now, if you go back to any of our previous videos, if you remember, the first half of this year, I pretty much talked about the 3-year plan of keeping inflation off without raising interest rates, both in Canada and the US. And I was always talking about early 2022 is kind of where I kind of thought we would have to see those interest rates come about to head it off. Well, now everyone agrees with me. So everyone's been watching the videos. So everyone's agreeing with that, or at least the consensus is that. But I might have an update on that in the second half as far as my view goes, based on what we've seen through the summer, certainly. And also the Wall Street Journal is, forecasting, of course, CPI to gain over last month. In the corporate world, GM is in digs with LG Corp to fix some battery problems around their Bolt, the electric car, the Bolt. And this is battery fires, so not a good thing for cars. And they're really working hard to track down and fix this problem. Not a surprise that we're seeing something like that in electric vehicles, especially the new generations of electric vehicles out there. Tesla, not to tout Tesla, you can see videos, in my opinion, Tesla. I like Tesla, but they've certainly been at it a bit longer than some of the other players in there. Around the battery technology and the vehicle technology, and LG here, who's developing the batteries, are having a bit of problem. Now this, battery fires are not a new thing. If you think back, let's say 5 years ago, Samsung's phones, remember you weren't even allowed to bring a Samsung phone onto a plane because they were overheating instead of, catching fire. And they had a big, massive recall, and they had to fix part of that technology. Well, GM and LG are actively try to head this off before it becomes a big problem and a big recall. So hopefully they fix it, and hopefully that's a learning lesson for other new entrants to the electrical vehicle market. From zippers to glass, we're seeing shortages. If you've been out shopping for anything, you know that the supply chain has been taxed really heavily as far as deliveries go. There's car shortages due to a chip shortage around the world, construction material, fixtures for homes, gardening. I mentioned we set up the kids in their places in Montreal, and IKEA was out of so many things. We had to start ordering things almost a month in advance rather than just go and buying them, because 1 week we look and IKEA was out of something, and the next week it was in, and we had to grab it before they were out again. And that's what we're seeing that across the board. So it doesn't matter what you're going to shop for, you're seeing shortages. And this is where, we talk about that transitory inflation. It's this lack of goods is driving up the price. And we saw that probably the best example over the summer was, wood, lumber. So, the construction market saw multiple times pricing on lumber, and a lot of jokes and memes out there about how much $1,000 would buy you of wood a year ago versus 2021. So that continues. We're probably not going to see this completely clear up until at least mid 2022, some predictions into 2023. Although we have started to see some improvements, not fixed, but some improvements there. So we're seeing a lot of pressures on inflationary prices. And that's again, the last 3 months, if you've been watching our videos, we've talked about this temporary surge, the reopening surge of inflation, and then it should taper off a little bit and return to normal inflation. And that's what we're really looking at. We're not really concerned about this transitory inflation. And that goes back to that statement I made about peak transitory inflation. Are we at the peak? Is this the worst that the inflation numbers are going to get? And they're slowly going to get better as that supply chain improves. That's what we're going to keep a close eye on. Hedge funds are praying for volatility just to justify the inflow of cash that they're getting. So people are putting more money into the market, they're putting more money into investments, and hedge funds out there are praying for volatility, because volatility is not bad. And I think we've done a volatility video actually, specifically talking about, don't be afraid of volatility. Volatility is an opportunity. If prices come down, that just means you're getting the sale price. You're sticking with good quality names. So, hedge funds are out there, hoping for volatility because they have all this cash influx, and the way the hedge funds work, the way that they manage, is on that arbitrage in volatile markets. It's the high activity trading. They're looking for that volatility, and they have not seen it over the last month. So they're out there holding on to cash, waiting for some sort of opening, whether by the sector, by geography, or just general markets, looking for an opportunity to jump in. On the U.S. front, the U.S. Consumer Inflation Index, as we mentioned, is kind of the highest since 2013, or the expectations is the highest since 2013. Again, this is everyone watching my videos and believing what I've been saying about inflation. So we're definitely seeing those expectations number. The expectations around those numbers to be higher, and we definitely still will see them a bit higher, I think, when we see the CPI this week. We're also looking at engine number one investment framework. They're actually taking not a new approach, but they're actually trying to tie companies' valuations to their climate impact. So, we use different formulas to value a company based on sales, growth, cash flow, growth of cash flow, all these different factors. Now they're looking to tie into that an actual valuation around their climate impact, or what they're doing to decrease their environmental or climate impact, and also what we call socially responsible management. So that'll be interesting as we see SRI or ESG becoming, ethical investing becoming more and more of an impact on people's decisions as we look at global warming and everything that's gone on that front. The U.S. is also awarding just over $480 million to aviation manufacturing to assist them to get their feet back on the ground. Obviously, everything around aviation was pretty stalled through the shutdown, as airlines were basically grounded. No one traveling. As borders start to reopen, as people start to travel again, we're starting to see those things pick up. We'll talk about Bombardier is actually increasing some of their spending at Porter Airlines, looking to spend more money on airplanes. So the U.S. is starting to put some money behind those manufacturers to allow them to get things up and running again, to be able to get production moving again. Coinbase, of course, we can't go a week without talking about cryptocurrency in some way. So Coinbase, which is the cryptocurrency exchange, or one of the larger ones, is planning to raise $1.5 billion through a debt offering, and this is to allow them to develop the product or develop the exchange offering more broadly, but also mergers. Because what we've seen through, obviously, this crypto resurgence, and I say resurgence because we had a big one in 2018. It petered off, where the valuations kind of fell and people lost interest, and now it's back again. They're looking to buy up some of those smaller ones, because we've seen a lot of small exchanges crop up everywhere. It's actually almost eroding confidence in people, because they're not sure which ones are real, which ones are to trust, which ones are going to last. So the bigger ones, look for a lot of M&A from the big ones, picking up some of those smaller ones, just to kind of clean up that space as it moves forward. Wells Fargo, we talked a bit about this court case. It's been ongoing for years. Well, ex-Wells Fargo execs are going up against U.S. regulators in a trial over the phony account scandal. So this goes back to Wells Fargo, and several other banks were kind of caught up into this. Wells Fargo was the center of it, where they had this bonus program all the way down to the branch levels of having people open phony accounts or open checking accounts or different product accounts for people who didn't even ask for it, and that was bolstering their numbers as far as new account activity and bonuses for different employees. It was a big, huge case. They had paid a big fine way back when, but the case is ongoing as really there was never really any, other than the fines, there was really no solid outcome or, anyone really found responsible for it. So that's why I think the case has continued on. Even the ex-employees who got fired who didn't want to take part in this scandal process, who got fired, and they had a class action to sue Wells Fargo for wrongful dismissals. That case got kind of dismissed, and again, no real liability to the corporation was ever seen. So hopefully, we'll see some sort of end, just or closure to this story, but it continues on. Apple this morning held their big special event to talk about their new products, the new flagship products. I only saw like brief snippets. I didn't watch the whole thing. I'll go back and review it later. You can certainly go watch it right from the Apple website if you're interested, if you're a techie. I mean, the biggest things were the new iPhone 13s were out. There's two models, the Pro and the regular. 5G, obviously at the forefront. If you're a photographer, I saw that they had big changes to the cameras. I'm not a photographer, see if you don't get from my expression and my reaction there, but it looked like it takes really great pictures if you know what you're doing. They also came out with a new watch, new colors to the watch, to the Watch 7. I didn't see a lot of changes from the Watch 6 other than a larger screen and new colors, things like that. The market wasn't looking for radical changes or a radical shift other than really the 5G. Oh, and they all have their new Apple microprocessors. So Apple switched to their own processors a while ago, or about a year or so ago. And this introduces that to the phones and to the watch, and I think an iPad mini. Anyway, faster, new chips, meaning faster and better battery life, basically what they're touting with these new products. But if you're interested, go check it out. I'll try to review more to see if there's anything more impactful for that. I don't think the market was expecting, and by the reaction of the stock today, the market really wasn't expecting anything radically new, other than minor improvements, and that's what exactly what they got. As I mentioned, the consumer price index is coming out. We are looking for it to increase by about 0.5% over last month's, and we haven't seen it yet, but really we don't expect a big surprise there. JP Morgan head is coming out to discuss, the health of Americans' largest banks and retail consumers and investors at a conference in New York. And again, it should be fairly positive. The banks have done well through the recovery, both, especially in Canada, but also in the US. All the financial institutions and hence the retail consumers also fared fairly well. Other top news, Uber. So if you followed, here's another court case that's been going on for a while. Uber treating their staff or their drivers as contractors versus employees. There was a big landmark case in California where they won to be treated as employees. Of course, that means more cost for the company. They've got to offer, vacation, sick leave, benefits, all these different things that add cost to it. I'm not saying it's the wrong thing to do. It's just, it changes the cost structure of what we call gig economies, and this goes towards, your skip the dishes or your Uber Eats or DoorDash or any of these kind of contract types of employees or types of work. It is split, I won't say 50-50, but it is kind of split with the workers as to whether they prefer to be contract or they want to be treated as employees, because some people like the flexibility of the contract work versus being full-time employee. But anyway, this has gone on and on, back and forth, and it is global. And the Dutch courts just decided that over in the Netherlands, they are going to be considered employees. So what does that mean for Uber there? They certainly talked about before of having to close down countries if they go that route. But if all the countries start going that route, what does that mean for Uber? Do they have to just kind of figure out a new way, a new cost structure to run things? And obviously, we'll see ripple effects from this to other gig economies that are out there. The U.S. House Democrats are looking to roll back the Trump tax cuts for the wealthy. Not a surprise; it's a big part of their platform. Tax the rich, go after corporations. Even when they met with the other global countries, looking to put a flat corporate global tax into place, meaning corporations wouldn't be able to hide their income in other jurisdictions around the world. They'd have to pay a minimum global tax on all the revenues. So no big surprise that they're going to take away those, or looking to remove those Republican tax cuts that were put into place, and nothing we haven't seen in the past, where Republicans have gone in and put in big tax breaks for corporations, and Democrats have come in and rolled it back. More M&A. Buyout firm Apollo is making a $4 billion bid for Tronox. This is a global management firm looking to pick up Tronox Holdings for an all-cash offer. More M&A, continuing. But that's a good sign that we're seeing that M&A continuing, because it means valuations are not out of range. A lot of people are concerned about the valuations around the markets. Are they too high? Are valuations too high? If we continue to see that M&A, that means at least the corporate world's out there still seeing value around what they're buying. The same thing when we're seeing deals here with Regenxbio Bio working with AbbVie with a $379 million upfront deal to sell their experimental gene therapy. And if you've listened to our video where we interviewed the CEO of Evolve ETFs, when we talked about kind of disruptive technology, gene therapy was right up there. Gene therapy treatment, and this one specifically for the chronic retinal diseases, which affect a lot of the aging population. We're seeing AbbVie taking a big run at that. Keep a close eye, but that gene therapy technology is definitely something we're going to see grow more and more when we talk about pharmaceuticals. The U.S. bankruptcy judge approved Purdue Pharma's $7 million executive bonus plan. So this has been the ongoing, this is the OxyContin painkiller lawsuit over the opioid crisis. Purdue basically agreed to make a big fund to go to help those who have suffered. Certainly wasn't enough. And now another $7 million going out to the execs through a bonus program. No one obviously involved or following this, are going to be happy about it. But right from the get-go, when Purdue put this bankruptcy plan into place, we knew it wasn't going to be the best outcome for everybody, and certainly the people who have suffered from the pandemic who have been affected by it directly. Coming up in Canada, I mentioned Bombardier is expected to hold a virtual event where they're looking to announce more new or updates to their private jets, which has been a big growth area through the pandemic. Believe it or not, a lot of people out there buying private jets. And if you remember the budget that came out, we did a budget video back in February, I believe, that coming in January 1. If you buy a private jet over 100,000, there's a new tax coming into place. So, get your order in before then if you're buying your own private jet. Stats Canada has released the manufacturing sales numbers for the country. Likely to fall a little bit. Obviously, manufacturing sales, again, being affected by that supply chain. Manufacturers just can't get all their parts. That used to be, a couple of days to a week lead time. Now are months, and it's really setting things back. Mining industry executives like Barrick Gold are looking to actually hold a conference this year. So the Mine Expo 2021 in Las Vegas. So this is, if you're in the hospitality industry, it's a good sign that, companies are at least planning to return to conferences. What does that mean? We're still seeing a lot of cancellation and postponements for 2021. Some companies definitely putting things on the back burner as far as getting large groups of people together, but we are seeing some moving forward. So it'll be really interesting to see which ones go forward and how they do, right? Hopefully we don't see super spreader events. Certainly, we're very likely to see mandatory vaccination at many of these different events to make sure that they reduce the risk to those attending. Private equity is back, and oil producer Strathcona as it's in talks to buy Caltex Resources. So this is again just showing some optimism around the oil sector. I don't want to overplay. Yes, we are seeing demand return for oil. We're definitely seeing numbers starting to, the outlook for numbers starting to increase, and the price of oil back through $70 again. So things are growing from that front. That doesn't mean we see, oil getting back to its heyday as far as demand goes, but from the lows where it's at, we still see some growth in those numbers. And that M&A is just more proof of that. Mentioned other airlines. Porter Airlines, if you're not familiar, for those out west, Porter is an Eastern company, mostly out of Hamilton Airport in Ontario, fly regional flights, mostly commuters from, not Hamilton, the city airport out of Toronto Island. They fly mostly commuters into Quebec and into the Maritimes. They've started to expand their offerings, and they've just put in a big order for 30 Embraer Air jets that will double their fleet size and looking to put routes into the United States, Mexico, and the Caribbean as they look at demand start to increase into 2022. As far as the dollar goes, the US dollar is held pretty strong. Now, remember when we ever talk about the US dollar, when there's concerns around the markets or weakness around the markets, global markets, US dollar is the flight to safety, so it goes up. That's where we've seen that strength. We are expecting that to pull back though, as we get over this inflationary surge, that starts to peter down, and the global environment starts to increase again. The global markets start to grow a bit faster than the US. So we are seeing the euro tick back up again, and we do expect the euro continue to climb as that goes through. As I mentioned, all likelihood the Fed Reserve will start the tapering, and that will, we'll start to see that weakness in the Canadian dollar. Yields on the U.S. Treasuries have ticked back up a little bit to 1.34 from 1.32, so not a big move. And PIMCO, a big fixed income or bond manager, one of the bigger ones in North America, his base case, it's talking about that, their base case is talking about inflationary pressures, that we are in a transitory environment, but nonetheless, they are staying cautious about that early 2022 potential tightening on interest rates. On the commodity front, as I mentioned, we're seeing a little bit higher, just over the $70 a barrel, up from, I think it pulled back to around 64 during our hiatus there, but it's come back up again. Copper ticked down a little, just shy of 1%, is still holding in strong. London's down a little bit, just as that, again, that transitory inflation number, really looking for that to pull back. So gold's not really running up too much at this moment. So let's take a look at the markets, excuse me, and where we see things coming for the fall. Well, as I mentioned, the vaccination rates are rising in the US and Europe and around the world, so that's very positive. Focus is really on that, the timing of the central bank tightening. The US remains a bit expensive. I won't say, we have very expensive here in the show, but I'd say a bit expensive. I still think that the reopening growth is a play. Although with that being said, we'll talk a little bit about my views on the US market here. Some really key indicators we're looking is the Fed wage tracker. So if you go back to earlier this year, as I mentioned, the two big things we have to watch is inflation and the labor market. What's happening there? And of course, the labor market right now, if you've been out at all, you know that there's a shortage of employees, especially in the service area. Whether this is due to minimum wage being too low, people find better work. Some people saying, the unemployment, benefits or the added CERB in Canada, and of course the extra top up to the unemployment in the U.S. was just keeping people at home. And maybe that's true. I can't say, no one can say, I think, for certain, except maybe the people who are staying at home can tell us that. But, that kind of speaks to the fact that if it makes more sense to stay at home and collect unemployment, maybe there is a problem with the compensation of some of those service positions when they could stay at home and make as much or the same amount of money versus going to work. So, that's something that we're going to have to keep a very close eye on, is what's going to happen with this labor shortage, what happens to the wage costs, because of course that drives inflation. If we start paying, people make more money, they can afford more things, they can pay more, it drives up inflation. It's just kind of a domino effect. And also, as I mentioned, inflation is kind of our big thing we're tracking. So stay with the reopen trade. So, as I mentioned, we still see that's the trade. The short term, this transitory inflation is not the trade we have in the portfolios. We're still looking at the long term. We still see, the best performing assets year to date. Definitely the smaller companies, small cap market, non-US equity, so outside the US. REITs have made a really big resurgence from their lows of March 2020. So that's your real estate holdings. And obviously, if you follow real estate, there's been a big boom there. Commodities in 2021 have bounced back nicely. And really that value company, we talked about the shift in February, March, I believe, shifting from growth to value in 2021. And it's been a slow shift, which is why we told everyone, don't sell off all your growth stocks and just randomly buy value, but definitely start to introduce and build that value in the portfolio. And I'd say even more so now, you want to start, building more and more around the value side of your portfolio and a little less around your growth names. Doesn't mean growth has fallen off a cliff, just means we're probably going to see a lot more focus on value going forward. Cyclical stocks, are going to do better as we move away from like the high growth tech stocks. Value, as I mentioned, is still cheap compared to growth as far as the different financial factors out there. Financials should continue to benefit from the yield curve steepening. I would stick with the Canadian financials personally. I see a lot more volatility in the US ones. Doesn't mean you can't look at them, or if there's a good buying opportunity, they shouldn't be there. But personally, I still like the Canadian ones. Especially with the dividend flow you get from them up here. And you can use a covered call strategy to enhance your dividend on those as well. The US dollar, as I mentioned, looking at some weakness once, investors have fully priced in any Fed tightening, which we're pretty much there. And the dollar weakness should support performance of non-US markets. So you're starting to get the theme. We're favoring outside of the US going forward for this year. Not to say we're giving up on the US, we're just definitely overweighted global over the US right now. From a Canadian perspective, the ease in lockdowns, which we should see them continue to ease. It's not a straight line, obviously, with bringing back the mask mandates. And obviously also with the schools reopening, that resurgence or that fourth wave is going to cause some effect as to how quickly or how directly we reopen, but that's still the game. That's still the play that we're seeing as Canada's market is moving towards a reopening, and we still see that as the growth story or the opportunity for the story. Growth should undershoot the first half. Growth undershot over the first half, but that's not a cause of concern. As I said, we are seeing value being more and more to the spotlight. Bank of Canada continues to taper asset purchases, but the likelihood of them raising rates before the U.S. very unlikely. They'll wait. They don't want to depreciate the loonie more than they have to, or quicker than they have to. The S&P, the TSX, sorry, has outperformed the S&P 500, and that's mostly to that commodity movement that we saw early 2021. And we're still in a very positive business cycle for Canadian equities relative to the US. So Canada and global over the US is pretty much our theme. We still expect a strong economy out of the US. Just a bit of overvaluation, some profit taking there is going to slow things down a little bit more. Eurozone post-lockdown recovery, we're expected to be very strong, stronger than the US, and also the currency getting stronger there. UK still got a set for a strong rebound. The pound is already seeing a bit of recovery. There's probably still some room for it to go up, but the pounds already saw a bit of a rally over what we saw in the euro. So a little less room there for them, but it's still a pretty cheap market compared to the US. Japan has been a bit constrained by their slower vaccine rollout, but as I mentioned, they can really ramp that up fast, just as Canada did. And if that happens, we can look at a better growth recovery over there. China is obviously putting in a lot of regulation, which made it hard on equities. And also they're dealing with, just challenges around some of the financials with the major corporations. They had a major financial institution this morning, I think, or yesterday morning, time difference, or at least late last night, looking that they might go into bankruptcy. Canada's recovery, both domestic and global, is very favorable for the Canadian equities, and again, the continued commodity growth, which helps Canada. As far as the asset front go, or asset class front, as we mentioned, we prefer non-US to US. Definitely favor value over growth. Emerging markets have lagged, but they should start to really reverse that course as the US credit growth stabilizes. Government bonds are still expensive, and we don't expect that to be a good area of growth for the next little while. Definitely on the fixed income. We're working very closely with some tactical managers on the fixed income, PIMCO being one of them. We've seen really good numbers out of a tactical approach in the fixed income market, and we expect that to continue. So if you're looking for, safer money, a little bit of volatility, not much, but a little bit of volatility, and looking for safer growth, those yields are north of 5 right now, and potentially, some capital growth there as well, depending on the inflationary movement. And hopefully the inflationary movement will be volatile, which will give more opportunity for the tactical managers to take advantage of that. And as I mentioned, the US dollar weakening. So with that, I'll want to wrap it up. I talked really long today. I appreciate everyone coming back. I know it's been a long month off. A lot has happened. We're going to get back to our regular weeklies. If you want to stay on top of it, as I mentioned, we have a lot rolling out. So go to mikeonmoney.com. You'll see anything that we're pushing out. Also, you can go subscribe to us on YouTube and get notifications every time we put out a video, or go subscribe to our weekly newsletter and our guaranteed weekly rates if you want to stay on top of those. But with that, I'll let you go. Enjoy your day. I'm glad to be back. Glad to be back at the office. And I hope everyone had a great summer, a safe summer. And I look forward to this next quarter with everyone. Thanks very much. Take care.